All right, welcome everybody to Management 222 on real estate principles specifically. We're going to be covering Chapter 13 tonight, and tonight is the final week, which means that if you're caught up to this point, all you have that will be graded to do this week is the final. So because of that, we will make tonight's focus the final. We'll talk about the material that you'll need to know for the test. Make sure we cover those topics so if you're taking notes tonight or as you review it later this week, the recorded session, you'll feel like you can come away with at least the topics that you need to study before you get to the test. I would suggest that you read Chapter 13, and then the test is comprehensive. So based on the topics that I'll let you know are going to be on the test, I'd go back through and find the information that you need to know before you get to the test and open it. There are only 18 questions on the test. It's worth 180 points. That means each one's worth 10 points apiece. And of course, that means that this test is worth just under a fifth of your grade, or 20%, just under 20% of your grade. So a very important test. Once again, relative to other classes that I teach, not a long test. None of the tests in this class seem to be very long. Having said that, just means that each one of the problems on the test is that much more important, right? Because each one is worth more points. So be very careful on the final. We will cover the final material at the end tonight. We'll probably get done a little bit early tonight because Chapter 13 is a fairly brief chapter, and since there are only 18 questions on the test, we'll probably get through things fairly quickly if I were to guess. So before we get started, Doug, Colette, thank you for being here tonight. Any particular questions that you both have or that either of you have before we get started about work that you've done to this point? Anything that I can help you with or clarify from past assignments, assessments, discussion boards, anything that has been covered to this point? And while you're thinking about that, note that everything that's been turned in to this point will be graded by tomorrow at noon. It's been consistent throughout the course. Usually it's by Monday night, so even a few days early relative to what the school requires. The school requires me to have everything graded by Wednesday at noon. We always make sure it's done by at least Tuesday at noon, but most times in a class like this, we can get everything done by Monday night. As I mentioned when we first started the class, I like to grade everything together. It helps me to be more equitable, helps me to be more fair from one student to the next if I grade everything together as opposed to grading it as it's turned in. But anything that's turned in on time will always be graded by, as we've talked about, Tuesday at noon. I expect that I should be able to grade everything tonight that you've turned in for last week, or late work even through this point. And speaking of late work, of course I accept all work up until this coming Saturday, but as we've mentioned, as we talked about in week one, this coming Saturday is the hard and fast cutoff, right? So no work will be accepted this Saturday after midnight. It's Halloween. It's kind of a big family weekend, so if it were me, I would study and take the final prior to getting to the weekend because of all the events and things and hopefully good times that will be had this coming weekend. All right, so I'm sure there's one or two of you that will be listening to this that will be saying, boy, I hope I can finish this class. I just feel so far behind. And once again, I would strongly encourage you to plan the time necessary this week to pass the class, get everything in. There's nothing at this point that would stop you from getting your late work in and still passing the class, even if you feel like you're quite a ways behind or find yourself, feeling like you're not caught up at this point. That's okay. Things happen, and I just strongly encourage you to continue with your work, get all of it in this week, and like I say, do it sooner than later this week with the holiday towards the end of the week. Doesn't change any of the due dates, unfortunately, with a class like this. Everything's still due at Saturday by midnight. So maybe it's a night that you'll hand out candy, and in between handing out candy, finish up the stuff that you need to do. Okay, Colette, Doug, have you thought of anything that we need to cover before we go on to Chapter 13? Any questions from past assignments, tests, discussion boards, anything like that at this point? So we're doing okay. Do we feel pretty good about the course at this point? Doug, Colette, are you feeling okay about the class? Good. Good. Well, it's usually the people that come to the sessions that are doing fairly well. So That's been fairly consistent throughout my time teaching online, as most of the people that make the effort to come to these sessions are usually doing okay. It's the ones that I can't get to review the sessions that are usually the ones that are struggling, and so I try to email them and try to make announcements that are beneficial to them. But yeah, it's folks who make the effort to usually come to the classes are usually in pretty good shape. So, Doug, Colette, if you think of any questions tonight as we go through the course, just write them into that chat box, and I will make sure and answer them. And then if you just can't think of anything tonight, but then throughout this week, if any questions come up, just send me a quick email, and I'll get back to you as fast as I can to make sure you're on track. And if I don't think to at the end, I just wish you a happy holiday week, a happy closing week of the course. I wish you the best of luck. I hope you do very well in the final to all of you. And frankly, as I mentioned in week one, I hope for all of you that you're all going to get the grade that you had anticipated or hoped for from this class, whether it be just to pass the class and get on to the next one, or whether it be to get an A. And if you find yourself this week having taken the final, and there's still a few days left in the week, give me an email if you find yourself just a few points behind on the grade you were trying to get, and we'll try to work something out. Maybe it's a resubmission on an assignment. It might be a little bit of extra credit work. It might be additional work on some discussion board comments or posts. But we'll try to figure something out. If you'll put in the effort and show and demonstrate effort and understanding, then I can improve your score in most cases. So be in touch with me this week, but get the final done early if you anticipate that being the case, because then we'll give ourselves enough time to work on your score. If you're emailing me Saturday night, unfortunately, with the holiday, it's unlikely that we'll be able to take care of that and try to improve your score Saturday night. So is that clear? Any questions about that this week, Doug or Colette, before we get on to Chapter 13? Okay, so Chapter 13 is very similar to last week's information. Last week, just to reiterate, we talked about the process of financing and the process of transfer and obtaining financing. So we talked about how you have to have a promissory note. Once you enter that agreement or promissory note with the bank, then the bank in turn gives you money. You give the money, right, to the seller, and then the seller gives you deed, and that deed is what actually transfers ownership. Now, title, of course, is still maintained or held by the bank or institution that gave you the loan, right? Because technically they're going to hold that and lien that if they need to get their money back. And we talked about the process of foreclosure last week, which is a process of banks and any kind of company that does lending. It's their process to try to recover the money that they allowed you to borrow and that you promised to repay. So if you don't fulfill that promise or commitment to repay, the only way they can protect themselves is to sell the asset, whether or not that be a house or a car or whatever it is. We talked about how repossessions and foreclosure is a similar idea. The process, of course, is much more complicated when it comes to a home than it is for a car. You default on a car, within a few payments, they'll come take your car, right? With a home, there's a pretty lengthy process and a lot of rules associated with how the government mandates that lenders have to jump through those hoops before they can take back a home, and you can understand why. They want to protect a homeowner and not kick people onto the street if they can all avoid it, and give them a chance to get back on and get back current with their payments. Okay, so tonight, Chapter 13 focuses more about where this financing comes from. We talked about how banks, do the financing, but one of the things we alluded to last week and that this chapter goes into a little bit more detail on is, you'll recall, if you listened to last week's session or were present, actually, Doug, Colette, can I put you guys on the spot? Do either of you remember where most of the mortgage financing comes from in this country? We talked about that last week. What entity has most of the market share when it comes to mortgage debt in this country? All right, both of you got it right, and got it right very quickly. Good work. Freddie Mac and Fannie Mae, right? So Fannie Mae and Freddie Mac. So Fannie and Freddie. So these are, as we talked about last week, they're highly supported and highly regulated agencies or companies, in essence. At this point, they're almost entirely controlled by the federal government. And the reason for that is when the federal government bailed them out in 2009 or 2010, okay, when they bailed them out post the financial crisis, that bailout came with a lot of strings attached. And basically those strings involved taking all their profit, okay, to repay the government for having to bail them out. And the regulation as far as what they're going to do with Fannie and Freddie all comes, and all is all dictated by what the federal government wants at this point. Now, prior to that, the federal government still had a lot of oversight on Fannie and Freddie and still supported Fannie and Freddie financially, but they were independent, publicly traded companies. Now, Fannie and Freddie are still publicly traded companies. However, as I mentioned before, their profitability goes back to the federal government at this point. So in essence, they're not really public companies anymore. They're or publicly traded companies. They're still traded, but they're basically run at this point by the federal government. Now, post-2009, the requirements from Fannie and Freddie got a lot more intense, obviously. Their underwriting got a lot harder. You have to actually verify your income now instead of just using stated income and lying about how much you make. So a lot of aspects of mortgages have gotten a lot better controls, but there also is a large group of individuals and just a lot of associations and groups out there that at this point are very concerned that Fannie and Freddie, being the largest market share of mortgages here in this country, have ballooned to such a significant size that if they were to come under duress again like they did in 2009, the federal government might not have the financial capability to bail them out again or to prevent them from failing at some point. It's similar to the argument about FDIC insurance that you may have all heard about. FDIC insurance is, of course, the depository insurance through banks that the federal government is the backer on. There's a long-standing argument that if enough banks and big enough banks were to need FDIC backing, that the federal government wouldn't be able to do it because there just wouldn't be enough money that the government could create, in time to bail out enough banks if enough of them went out of business at once. So the same argument is true for Fannie and Freddie. The balance sheet at Fannie and Freddie is so large now with so many mortgages that there's a concern that if the mortgage industry fell apart again, that there is a scenario where maybe the federal government can't come in and bail them out like we did 5-6 years ago. So just to be aware of that, you might read articles that talk about Fannie and Freddie and how there is concern about that aspect of their financing at this point, since they're the primary financier now or primary mortgage debt holder in the United States. Okay, so that's kind of a little bit of background. That's how the 2 weeks kind of tie together as far as Chapter 9 from last week. If I'm not mistaken, it was Chapter 9, and Chapter 13 this week. But let's go through a few slides. There's not a lot of material this week on the slides, but let's go through a few. Okay, that was off to a good start. Let's try that again. All right, that's a little better. So where does financing come from? There's a primary and secondary market. The primary market is where the lenders actually originate loans, and the secondary market actually allows, okay, let me go back. It allows for those primary lenders to basically package loans and sell them. Okay. So what does that mean? What that means is if a Wells Fargo underwrites a loan, or if even Fannie and Freddie, if they actually take on loans, or if Chase Bank, those are some of the biggest ones, Bank of America, Wells Fargo, if those folks write loans in the primary market, they can then package them and sell them in a secondary market as well. Now, Fannie Mae and Freddie Mac are not ever in the primary market. They are not a direct lender, okay, in the primary marketplace to you and I as consumers. We can't go get a loan directly from Fannie Mae or Freddie Mac. What we can do is buy our loan through Wells Fargo or Chase, our local bank, or a broker, right? ABC Mortgage Company at the corner of the street. And it's likely in the secondary market that those brokers or banks will then sell our loan, okay, the right to our loan, to Fannie or Freddie Mac, okay? And so the secondary market is a very important marketplace in the mortgage industry because it allows for banks, investment companies, and most importantly, Fannie Mae and Freddie Mac to assume mortgage debt that they didn't actually underwrite themselves. And then the primary marketplace is very important as well. It allows companies like Zions Bank that I work for, or Chase Bank or Wells Fargo, to write their own loans as well. It's not as common now because all mortgages end up at Fannie and Freddie, but there still is an aspect or an element of mortgages that get written that will end up staying at the institution that writes them, and in that way it's a primary market or primary mortgage for those companies. So here are some of the primary loan sources. You've got mortgage companies that actually hold paper, brokers that actually underwrite, life insurance companies, commercial banks, and savings and loan institutions. All these are places that actually write loans, okay? Actually underwrite loans. Some of the ones that you probably weren't as familiar with are savings and loan associations. S&Ls back in 1994 during the S&L crisis almost wiped out the S&L industry to the point where now you've got primarily banks and credit unions, but you still have some S&Ls, some savings and loans, not very many. These are kind of your community savings and loan institutions that focus on giving you the highest depository rate they can, and then primarily they're just in the mortgage business. And there are very few of those left. A lot of your large regional banks and large local banks started out as S&Ls and then expanded into, traditional banks. You got your large commercial banks like we talked about, like Chase and Wells Fargo. Then you've got some life insurance companies that will underwrite mortgage paper, like, for example, MetLife is a large life insurance company that ends up writing. State Farm's another one that does property and casualty insurance, but also a lot of life insurance that can end up writing loans, mortgage loans as well. Then you've got mortgage companies like we talked about that actually specialize in mortgages, and then you've got brokers. So mortgage companies are usually the ones that hold paper, actually hold loans, and brokers are the ones that are just underwriting a loan to immediately resell. There's not as many mortgage companies anymore. There's a lot of brokers out there. Most companies don't hold their own loans anymore. So in that case, most everybody acts as a broker now to Fannie and Freddie, is the bottom line. Yes, Colette, good distinction. This is something that we should point out. All these companies, life insurance companies, S&Ls, commercial banks, mortgage, all these folks can service the loan, right? Now, some of them don't want to service loans. They're not in the business of servicing loans, like mortgage brokers, right? So that would be a distinction between them and the rest of these companies. Mortgage brokers don't even service the loan. They sell everything about the loan, both the servicing and the actual paper itself, to another entity. But most banks, as one of the largest primary market loan sources in the United States, most banks like a Wells Fargo or Chase, even Zions, what they'll do is they'll sell the paper. When I say they sell the paper, they sell the obligation, the debt itself, to Fannie or Freddie, but they actually maintain the servicing, right? So if you have your loan through Wells Fargo, that's fine. Wells Fargo probably does not hold that actual debt. They've sold that debt to Fannie or Freddie, but they still maintain the servicing, and that's where they do get paid to service that loan. And so it's a lucrative business for big companies like Bank of America and Wells Fargo to continue to service loans even though they don't actually hold the loans at the bank. And if you understand that, Colette and Doug, you're light years ahead of most people as far as mortgages are concerned. Because most people, if I have my mortgage at Wells Fargo, I just think that Wells Fargo actually holds my loan. But reality is Wells Fargo is probably just the servicer, right? And they've probably sold that loan to Fannie or Freddie, but maintained servicing of the loan itself. Does that make sense? Any further questions or clarification on that? That's a great point, Colette. Thanks for pointing that out. It helps our discussion quite a bit. Okay. All right, we've got a few other ones. Actually, let me just back up. I will say that in the primary marketplace, computerized loan origination is becoming more and more common. Perhaps the two big ones are LendingTree and Quicken Loans. Quicken Loans is more of a underwriter in the primary marketplace, where Lending Tree is more of just a site where people can go and then find different loans that are right for them, where Quicken actually underwrites them themselves. Quicken has become a very large lending institution based on their online presence, right? We don't have Quicken loan centers, or at least if we do, they're not nearly as prominent as the commercials and the websites, right? Or excuse me, the web advertising that they do for us to get Quicken loans. So that's become a big part of the loan industry, these computerized loan originations. Then you have your secondary sources. Sorry, got ahead of myself. FNMA, that's Fannie Mae. GNMA is Ginnie Mae. The Federal Home Loan Mortgage something, FHLMC. And then Farmer Mac. Farmer Mac is mostly mortgages, obviously, for farmers. You've actually got Sallie Mae for student loans, right? But we're just talking about mortgages, and these are some of the main institutions that end up buying the mortgages from these primary underwriters, okay? One of the biggest sources now that I would add to this list is hedge funds, private equity companies, and investors. So you can pool those all in a group and say investment companies or investors. And what ends up happening is a company like BlackRock or Blackstone or KKR, which are huge investment conglomerates, meaning people will invest their money in these groups, and then these groups are expected to go out and buy things to make money. One of the major things that they do or have done over the past 5 years is these groups will go out and buy mortgages and buy huge amounts of mortgages from banks that don't want them. And especially right after the financial crisis, those banks, the loans that they did hold, right? Not necessarily Fannie or Freddie, but the loans that the banks still held, which they still held some, they were anxious to get rid of, right? To get that debt off their balance sheet. They were experiencing high foreclosure and delinquency rates. And so they were excited to sell them very inexpensively to these investment groups. And in essence, these investment groups became a force to be reckoned with as far as the secondary loan market. You've got some of these now that own billions and billions of dollars worth of mortgages. And you might even be in a situation today where if you had your mortgage through the last 10 years, it might have been sold to one of these groups to now service your loan. One of these groups that came in and did what we call vulture. They created a vulture fund, which means that you circle around like a vulture does when there's a crisis, right? And in this case, the crisis was the mortgage market, the mortgage industry. And so these vulture funds came in, these investment groups, and bought up lots of these mortgages. And they're making lots and lots of money. Ended up being a great investment, right, when things were bad, to come in and buy those mortgages, because now there's less default, right? And a lot of those are being repaid and are making these companies a lot of money. So anyway, I would add that to the list. These big investment groups have created a significant part of the secondary market now. So here's a graphic of what might happen. You've got mortgage investors that buy from financial intermediaries. Okay. Those financial intermediaries are buying from the mortgage lenders, which are basically the ones extending the debt or underwriting the debt to borrowers. Borrowers are the same people as mortgage investors, right? So just like how a bank works, you as a bank customer are both a lender and a borrower from your bank. You know how you're a borrower, right? We get mortgages or we get car loans, but how are you a lender to the bank? Colette or Doug, any ideas? How are we, you and I as customers, how are we lenders to a bank? Because we don't really write loans, right? It's not like we're writing up a loan agreement with the bank. They're the ones writing the loan agreements with us. But the way that we're lenders to the bank, just like you're both a mortgage investor and a borrower at the same time, according to this graphic, is exactly what you just said, Doug, which is any depository account that we have at the bank. Savings, checking, money market, CDs, any of those depository accounts are in essence a loan to the bank, right? Because then the bank turns around and takes our deposits and lets people borrow money from them. Okay, that's how they get the money to lend out is from our deposits. Okay, so we as customers of the bank are both a lender and a borrower. We're a borrower because we know how we're a borrower. We're going to borrow money to buy houses and buy cars and whatever we're buying, use credit card debt, stuff like that. But we're also the lender because any checking or savings or CD or money market that we hold at the bank, they're using, in essence, to lend money. Okay, same thing is true for the mortgage industry. You've got mortgage investors and borrowers who are exactly the same group, folks who are borrowing and investing. Okay. I'm not going to go over this graphic. This is basically how it works. A few years ago, right after the mortgage crisis, we'd talk about this quite a bit because a lot of people would say, now, it's the bank's fault, right, that the mortgage industry fell apart. And I would say, yeah, in part, right? They were originating bad loans, right? But then they were selling them off to investment banks that were, or excuse me, groups that were packaging those loans and then selling them to the investment banks. And then they were selling them to investors. And all along the way here, everybody's driven by greed because they're making money, right, at each step of this process. So all three of these steps were getting way out of whack, okay? People were writing bad loans. That was the bank's fault, right? They were writing bad loans. They were lying on applications. They were encouraging people to borrow way more than they should. Then the groups that were taking the debt away from the bank and paying them money, the bank was incentivized to basically say that these loans were awesome, right? That they were never going to default, that they were great, they were AAA, highly rated. So then the purchaser would want to buy them and pay them money, right? They'd make money there. Then the purchaser or packager, these companies that would package them and give them and sell them to the investment banks, they were motivated by money to kind of make these loans seem better than they actually were. And finally, the investment banks were motivated to make them sound better than they were to their customers so that they would invest, right? So by the time you went from here, this borrower who didn't have any money, right? The bank lied about how much they made, okay? Stated income, stated whatever they had to get the loan. Then they lied about how good the loans were, right? And packaged them to give them to the packagers. And the packagers made them even better. Then the investment bankers made them even better. And by the time you got down here to the investors, let's say different countries in Europe that were really big investors into U.S. mortgage debt, they thought they had mortgages that were high quality. So like AAA rated mortgages. That's what they thought they had after all this process. In reality, you had borrowers over here, right, that didn't have any money, that didn't even have a job sometimes, that were just, trying to flip houses to make money. Couldn't even make payments, in reality. They were just trying to pull more money out every year because you could back in 04, 05, 06, 07. You could pull more money out of your house every year just to cover the payments if you had to. And then everything fell apart in 2008, and some of these folks couldn't even make their payments, lost their houses. And these end investors over here are the ones that really got slammed, right? Because these mortgages all of a sudden their investments weren't worth hardly anything. But it's a lie here, it's a lie here, and it's a lie here that started that process. So yes, the banks were greedy and made a lot of mistakes and did things wrong. But there were these other steps of the process that were wrong too. And in the end, there's a good argument to be made that, hey, isn't some of the responsibility right here on the borrower? Shouldn't you be honest on an application? Shouldn't you, if you promise to pay a loan, shouldn't you make sure that you can make payments before you take on a loan? So some of the responsibility has to come back on the borrowers, right? But a lot of the responsibility goes to this whole process that really broke down on us and created a lot of problems. Any questions on that? Okay. It was pretty disastrous when everything fell apart because these investors were holding on to lots and lots of mortgage investments that weren't worth as much as they should have been. The concept of usury is getting interest, okay? The interest that we receive on borrowing money. And a like the Muslim faith, in Islam, usury is a sin. Okay, so if somebody's following the Quran and truly are following the tenets of the Islamic faith, they will not lend money and take interest, and they will not put money in a savings account at a bank or a CD because it gets interest, and that's considered usury as far as they're concerned and against their religion. That's a complete aside note, but I just thought you might be interested in that. Now, as far as laws are concerned, Congress and state legislations have put caps on how much banks can charge, but those caps are so high, we haven't even been in a situation where we even know where they are at this point. Back in the 80s, when interest rates were really high, that was more relevant. Nowadays, interest rates are at all-time lows, so we don't even have, most of us couldn't even tell you where these caps are. They're like 16%, but nobody has a 16% mortgage anymore, right? Everybody's got a 2, 3, 4, 5% mortgages. They're all really, really low. But if we get into a situation where interest rates go way up again and where inflation is really high like we had back in the 80s, then this concept of legal ceilings, okay, on the interest rates makes sense again, okay, because we don't want banks charging 20% interest rates. Nobody would be able to buy a house. So they artificially put in ceilings, and you know, there's a good argument to be made that creates problems in a free market economy to put it, you know, to put regulations like that on banks, but it prevents banks from gouging individuals, you know, and helps people be able to get into homes, which is a big, which is something that the government's very, very interested in making sure happens in this country. Home ownership is one of their. That's why Fannie and Freddie Mac exist, is because government wanted to support and sponsor home ownership in this country and increase that. It helps create a middle class and strengthens a middle class to promote home ownership. Due on sale clause is just a situation where if you sell a house, then the mortgage company gets first right at the money, right? So if you sell the house, immediately that mortgage is due. You don't get to take that money and do whatever you want. You have to pay off the mortgage immediately if you were to sell the house. And then sometimes there's prepayment penalties where if you pay off your loan early, you'll get charged. And the reason for this, and you might think, well, that's crazy. Doesn't the bank want their money back? Yes, of course they want their money back, but they also want interest. You know, they're in the business of making money off the interest associated with your loan, right? And so if you pay off your loan too fast, then they don't make the money that they paid, for example, in commissions to the broker who sold you the loan. They don't make their money back. And I mean, the upfront process as far as underwriting a mortgage, a new mortgage, is actually very costly to the bank. They don't make their money back for years. And so if you end up paying off your mortgage in a year or two, they have many times a prepayment penalty to recover the costs and commissions that they paid to put that mortgage in place. Okay? So just be careful if you are planning on paying off a mortgage very quickly, that you understand if there are any prepayment penalties. There are loans out there that don't have prepayment penalties, so but most mortgages do. Okay, especially in the first 5 years or so, 3 or 5 years, they need at least that amount of time to make back the commissions and fees associated with underwriting the loan. Okay. That's all I wanted to cover as far as the slides tonight. Any questions or concerns before we get to the 18 test questions, the topics that you need to know for the test this week? All right. Doug and Colette, you guys are on top of all this stuff. Nothing new here, right? Hopefully you learned 1 or 2 quick things, but it seems like both of you are have a pretty good understanding of this stuff, and so hopefully it wasn't too painful of a review for you. What we're going to want to know this week for the test, we've got 18 questions, as I mentioned before, most of which, if not all of which, are multiple choice. I was going to say there might be 1 true-false question. Nope, it's all multiple choice. Okay, so you got 18 questions. Every single question's worth 10 points, so 180 points total, just under a fifth of your grade like we talked about overall in the class, just on this one test. So number 1 on the test, you're going to want to know the difference. Okay, you remember a graphic from like 2 or 3 weeks ago? Well, actually it was in week 1. There was a graphic from the book and in the slides that showed you how we break down pieces of real estate, right? So we had like a township at the end, but we had like a section, and we had those different, we had different plots and lots, Anyway, there was a graphic for that. You'll want to make sure you understand which one of those sections makes up 640 acres usually. Okay, which one of those sections makes up 640 acres? Okay, how they break those different pieces of real estate up. Which one represents usually about 640 acres? And you'll get number 1 right on the test if you know that. Number 2 on the test, this is kind of a trick question, says an estate in severalty is held by how many owners? Okay, I'm not going to give you the answer, but just know that that's kind of a trick question. Make sure you understand what an estate in severalty means. Okay, because if you just think, well, I'm going to look at the word and understand it, then you're going to get it wrong. So look at what the book has to say about ownership, right? This is an ownership type, and it's an estate in severalty. What does that mean? Okay, how many owners? Number 3 on the test, we talked about meets and bounds in week 1. Okay, when you talk about meets and bounds, you're talking about direction and distance, right? So in common terms, that would be direction and distance, and that's how we tell the terms associated with a lot, right? And this is a very scientific way, right? We got degrees, that helps us with direction, and then we've got distance, exact distance, and that helps us with how far in each direction. Meets and bounds of a survey always start at one point and end at one point, and that is the same point. Okay, let me repeat that. Where you start when you're talking about a lot is where you're going to end as far as meets and bounds are concerned. It makes sense, right? Because the lot has to be enclosed as far as distance is concerned and direction. It can't be just an open line, right? Because the whole point of meets and bounds is to encompass your particular piece of real estate. And so it can't have holes in it. It has to be an enclosed, so you have those different points that we looked at in week 1, where you have direction and distance between points and an enclosed piece of property. Okay? So your beginning point is your ending point. If you understand that, you'll get number 3 right as far as meets and bounds are concerned. Number 4, you're going to want to understand the basic rules of tenants in common. That's an ownership type we talked about. What are some basic rules associated with tenants in common? You'll get number 4 right. Number 5 on the test asks you what type of ownership affords you the most control and the most flexibility. Okay, and we talked about how sole ownership does that. What are some other words or names for sole ownership? Before you get to the test, you're going to want to know different ways that we can say sole ownership, because it's not going to say sole ownership. Okay, so we'll need to understand what else it could be referred to as. Make sure you understand what an alienation clause is. What is an alienation clause? And who does it benefit? Okay, does it benefit the lender or does it benefit the borrower? The alienation clause. Does it benefit the borrower or the lender? Okay, who is it meant to protect? The alienation clause. Number 7 on the test. Make sure you understand that a mortgage or trust deed is considered a debt instrument or a debt security. That's for number 7 on the test. Number 8 on the test, make sure you understand the process that we talked about last week of obtaining money, okay, or evidencing a piece of debt. We talked about it's the step 1 in getting a mortgage or getting a house transferred over to you. What is step 1? Number 9, make sure you understand what jointly and severally liable means. Okay, the phrase jointly and severally liable. What does that mean in real estate terms before you get to the test? Number 10, make sure you understand what an acceleration clause is and who it benefits. What is an acceleration clause and who does it benefit? Number 11 on the test, make sure you understand what the due on sale clause is. And we talked about that just a few seconds ago, one of the last slides tonight. A due on sale clause, what is that? Number 12 on the test, who can you get a VA or an FHA loan, which are just certain types of loans, okay? A VA or an FHA loan, who do you get them through? What does the book have to say about that? Number 13 on the test, if you have concurrent ownership or interest, this is a kind of a repeat question from a prior week. think a couple weeks ago. Concurrent ownership just has to have more than one owner, right? Because you can't have concurrent ownership in one owner. Concurrent, by definition, means that there is more than one owner. So you need to understand that for number 13 on this test. Number 14 on the test, make sure you understand what types of loans Fannie Mae is buying. What types of loans does Fannie Mae buy? There are certain types of loans that they do and certain types of loans that they don't. Make sure you know that before you get to the test. Number 15 on the test, make sure you know the requirements for a deed to be valid. This is a repeat question, I think, from week 1 or week 2. I think it was week 2 that we talked about deeds and transfer of ownership. So you'll want to recall that list of aspects of a deed that must be present for it to be valid. And this is, like I say, a repeat question from that chapter 2 test, or that week 2 test, excuse me. Kind of gives you different things that have to be there, and then different things, and then it gives you an example of something that doesn't have to be there or doesn't have to occur. Number 16 is another kind of repeat question from week 1. It talks about the tests for fixture. Remember how we talked about real estate, fixtures of real estate stay with the property, stay with the real estate when it's sold. What are those tests associated with testing whether or not something's a fixture of a property or not? You'll need to remember that list and be able to identify what is on that list and what is not on that list. Number 17 on the test, we talk about primary mortgage lenders, the primary market and the secondary market tonight. Make sure you understand what it means to be in the primary market or the primary mortgage lender. I gave you some examples of that. We talked about what is happening in the primary mortgage market. Just have that in mind for number 17 on the test. Number 18 on the test, you need to understand what a mortgage broker is. What is their role? We talked about that a little bit tonight. Make sure you understand what the book has to say in chapter 13, right, which is the chapter we talked about tonight. Make sure you understand what the book has to say about mortgage brokers, okay, where they get their money and what do they end up doing with their loans, okay? What are mortgage brokers? Okay, that's number 18 on the test. Should be in good shape if you understand those questions or those topics. There are a few things that you'll probably need to go back to the book and study a little bit more, but that's it. So any questions about those topics before we wrap up for the night? Okay, anything at all that you'd like to know about anything as it pertains to real estate, personal finance, investments, anything at all that is of financial importance to you that you wouldn't mind asking on a public forum like this? Okay, so Colette, you're in good shape. Okay, Doug, you're in good shape. Have a great night. We'll wrap up early then. Have a great week. Good luck this week, and let me know if you have any questions or concerns. But thanks for being here, and have a good one. You too, Doug. Have a good holiday week. Colette, have a good one.